What's up, guys? Today we're gonna go through liquidity and what it is. As I said in my previous video, if you watched it, I was gonna do a bit more trading lessons and all that. So today I'm going through one of the confluences that I use to start my trade, which is liquidity. Pretty important piece of a confluence that I use. It starts on my trades, like I said. It's what I take my initial base level off, and it's one of the first things that I learn when I start trading. So the best thing I find to go through is what actually is liquidity. So it's the resting orders set by big banks and institutions in the form of stop loss, takes profits, stop orders and limit orders. So we know that there's going to be a lot of people willing to buy or sell in that location, mostly big institutions and banks, because they can fill the orders, they can push price down in order to buy it on the cheap, and then they're going to obviously buy, which is a lot of orders, which sends price higher. It's just a pool of money that's achieved when people are going to be entering and exiting the market. And obviously it's important because, like I said, we get a lot of volatility off this, and this is obviously when you're not going to be trading chop, you're not going to be trading all of that. It's hard to trade. You want to be trading nice, clean moves up like that, which is, if you're going to follow my strategy, it's how I trade. I don't want to trade. I mean, supply and demand, perfect if you just rebounding with the zones, but I want to be catching fucking big dicks to the upside and to the downside. And the banks just seek liquidity so they can exit market orders at the cheapest price possible, obviously making more profit and just manipulate the markets. Obviously, I'm sure you've heard about manipulation and distribution. Obviously, the manipulation phase is going and taking out a high, distribution is distributing the orders and taking out that high. So that's pretty much a rundown of liquidity and what it is, what it means, what it stands for. Now let's go into some examples. So I'll just draw out an example of taking out highs. So obviously we know that resist liquidity lies at levels of high. So every high here, for example, we come up, we sweep this liquidity, and then we see rejections to the downside. It's a liquidity sweep. It's really not like it's not complicated. People overcomplicate that is all it is. And it's just obviously a high is an up candle, then a down candle, a low is a low candle, then an up candle. That is low, high, which is and then liquidity is just resting every high, every low is where liquidity is held. You've just got to find the areas where we look for rejections. So for a bullish example, you can see we've got the upside here. Then we see a big candle down. Obviously we take that high, we come up, we take out that high. So here we can see the bank is pushing price higher to sell and make increased profits, which is we want to be catching this move here through our other confluences. So the liquidity sweep is kind of what we start our trade with. And then obviously what does that look like to the downside? Obviously we're coming down, we go up, we take a sweep, this is the low, we take out that, and we see rejections to the upside. So that's liquidity. What I do then is I maybe go on the 1 hour and I literally just go and snipe liquidity sweeps. Honestly, they're all over here. As you can see, on the 1 hour we have this hourly high here. Price comes up, takes it down, and then we just see that shits the bed to the downside. And that's just the liquidity sweep, and then from that we'll be going down 15 minute, 5 minute looking for entries. But this is what I base my trades off. So I literally just, what I do is I go, when I was learning it, I go and I just look for sweeps here, see this low, perfect example here. Obviously we've got a low here, we come down, this candle takes it out, and then we see a big rejection upside. You'll notice a pattern when we come and sweep our liquidity. It's usually a big move to the upside. I'll try and find a good example. Or a big move to the downside when you can tell it's going to sweep out liquidity. Damn bro, gold has just been... Here's a good example. So you can see we have all of this just quick down to the downside. We kind of just move down really quickly. Then we obviously sweep out this low, take out this low, and then we see rejection up. So this is all banks pushing price down very quickly so they can buy it all back again. And this works on any time frame. Obviously, if we scale down to 1 minute, you're still seeing liquidity sweeps. Not as powerful, but definitely I still see liquidity sweeps here. I mean, look at this, you come in exactly into it. You look for a break of structure, maybe for that candle. Stops there, take profits at these highs. And you're at 1 or 2 risk reward ratio, so it's just about finding liquidity. So what I task you guys to do is go on each 4 hour, 1 hour, 15 minute, 5 minute, 1 minute. Find 10 liquidity sweeps on each time frame. Remember, key points to remember are it's above highs and lows, so you can't just say, oh right, there's a wick here, that's a liquidity. This candle causes a liquidity, but it doesn't on the 4 hour, because obviously we see it's all just up and there's no high created, so that can't be classed as a liquidity level. So just remember that. Do the homework, get 10 liquidity sweeps on each time frame, and yeah, that's a quick run through of liquidity. Any questions, then you can ask me. I think my next kind of lesson, if you like, will be on breaker structure in the market, which can help us. Obviously, we're going to start building up the building blocks that we can use to help us take a trade.